Hello, I'm your professor, Dr. Stephen Haggard, and this video is about capital structure. If you think back to your first class on corporate finance, we said there were three questions that we're trying to answer in corporate finance. The first is, what assets should we buy? And the second one is, how do we finance those assets? The third question is, how do we manage the short-term cash flows of the firm? We called that second question, how do we finance the assets, the capital structure question. And that's what we're talking about here today, capital structure. So what are the three sources of capital that we see for firms? First of all, there's capital that they generate themselves. We refer to this as internal equity. When the firm makes a profit, in accounting terms, net income, anything they don't pay out as dividends from that net income becomes addition to retained earnings, and that all gets accumulated in the owner's equity on the balance sheet. And so the addition to retained earnings, or the undivided earnings of the firm, becomes an internal source of equity for the firm, and they can use that money to make further investments. Firms also have external sources of capital. For example, they can go outside and borrow. We call that debt. And this borrowing could take the form of bank loans or bonds, and there may be some other little ways that they can borrow, but that's all borrowing. And then finally, we have external equity. And this is where the firm issues additional shares in exchange for money. Now, the problem with this is that those external shares now, that brings in new shareholders and it dilutes the ownership position of the previous shareholders. So those are our three big sources of capital for firms. Now, you would think by this time in finance that we would have a theory that explained exactly what goes on with capital structure at firms. And truth be told, we have at least three theories. Actually, there are more than that, but I'm going to tell you about three here. And the first is called the trade-off theory. And the trade-off theory says basically that we are trading off the tax shield of debt with the expected cost of financial distress. Now, what does that mean? Well, the tax shield of debt comes from the fact that interest is tax deductible. This isn't something we can say about equity. Dividends aren't tax deductible to the firm. And so we end up with a situation where there's a preference for debt because of this tax shield it provides. But debt isn't an unmitigated blessing. It actually creates the possibility of bankruptcy or financial distress. In fact, the more debt a firm has, the greater that probability is. And the expected cost of financial distress is the probability of financial distress times the cost of financial distress if it does occur. And so what we see is the expected cost of financial distress increases the more debt the firm has because of this increased probability of financial distress. So on the one hand, additional debt brings us more tax shield, but on the other hand, it's going to bring us greater expected cost of financial distress. And so what we want to do is balance it to the point where one more dollar of debt that the additional tax shield it brings will be exactly offset by the increase in the expected cost of financial distress. And at that point, we are said to be perfectly trading off those two things. So that's our first theory. Now the next one is called the pecking order theory, and it's motivated by something called adverse selection. Adverse selection is when two parties in a transaction have different amounts of information, and the party with extra information takes advantage of that situation to basically cheat the other party. So the biggest example of adverse selection we have is in the insurance market. If I think I might be sick, then I am more likely to get health insurance. If I get up in the morning and I'm coughing up blood, Instead of going straight to the doctor, perhaps I stop by my insurance agent and I get health insurance and life insurance. Now, I'm very careful not to cough up blood in front of my insurance agent. I'm taking advantage of my superior information in order to basically cheat my insurance agent by getting them to underprice the risk. Now, where is the adverse selection in our story? It's between the managers of the firm and the investors. Who do you think knows more about the true value of the firm's stock? It's got to be the managers. They have more information about what's going on in the firm. And so they might take advantage of that superior information in order to trick people into buying their shares. But investors aren't stupid. And they realize that if managers are trying to sell additional shares, there's a good chance that the managers think those shares are overvalued. And so, as a result, investors will only purchase the shares at a discount. Now, managers know this, and so they are going to, therefore, make issuing shares their absolute last resort when trying to raise new capital. This is according to the pecking order theory. And so the pecking order theory says this: managers will use internal funds first and then external funds. The internal funds, of course, are internal equity. And why would they prefer to use internal funds? Well, internal funds don't bring additional scrutiny on the managers. Remember, in the agency problem, one of the ways that we limit it is through additional monitoring. Nobody likes to be watched, and managers do not want to bring additional scrutiny or monitoring upon themselves by issuing additional securities in the markets. And so if they could get by with only investing using the firm's internal resources, they would do that to avoid further scrutiny. But maybe they've got an opportunity that's just too delicious to pass up. And so now they need to reach outside the firm for funding. Would they choose debt or would they choose equity? Well, given what we just learned about the negative signal that issuing shares sends, we would assume they would want to issue debt. Furthermore, issuing debt doesn't give up any control in the firm, and you don't have to share the profits with any new shareholders. In other words, the current shareholders aren't diluted any by taking on additional debt versus issuing additional shares. And if you've got a great project that you're trying to invest in, you would rather do it on the basis of a fixed repayment scheme instead of sharing the gains. Here's what we know about people. People are scumbags, and people like to share bad things. If that weren't true, we wouldn't have the saying, misery loves company. Do people like to share good things? Not really. And so if a company thinks they've got a good project, would they rather issue equity and share those gains with the new shareholders, or would they rather issue debt? They'd rather issue debt. Now, what if they think it's a bad idea? Well, then they would prefer to issue stock and share those losses with the new shareholders, because remember, people are pleased to share bad things. And so all of this pushes us toward the pecking order. Internal equity first, and if you have to go external, you go with debt. And if you have absolutely no other alternative, then you would go out and issue additional shares. Finally, let's talk about the target adjustment theory. And the target adjustment theory is actually motivated by the trade-off theory. And it's basically saying that there is an optimum capital structure for every firm based on this trade-off that we talked about earlier. And therefore, firms will have a target capital structure that they will try to maintain. However, firms can't maintain this exactly all the time, simply because there's just so much in the way of transactions, costs, and just problems in continually issuing debt, repurchasing shares, those sorts of things to try to keep this capital structure exactly where it should be. And so what we find is over time the capital structure drifts away from the target capital structure, and then managers will overcompensate and put it to the other side of the target and then let it drift back toward the target and then past until they do this thing over and over again. So let's talk about what happens at a profitable firm. At a profitable firm, if they're not paying out all of the dividends, all of the net income as dividends, then we have addition to retained earnings. The total equity will increase over time. That's going to naturally push down the total debt ratio, which is total debt over total assets, because total equity is increasing while total debt stays the same or goes down as debt matures. And so these firms, their total debt ratio will actually drift down over time. And they'll drift down to the target level and then beyond until they get to a trigger point where managers go out and issue a bunch of debt and use it to repurchase shares to push that total debt ratio back up. And they do this over and over again, and so the total debt ratio, a graph of it would look like a zigzag line going up and down. Actually, it would go down and then straight up and then go down and then straight up. That's total debt over total assets. What about an unprofitable firm? A firm that's losing money will have negative addition to retained earnings, and so over time their total equity will shrink, causing their total debt ratio to drift up. At some point they will issue equity to drive that down and pay off some debt, and then it will start to drift up again because they're still losing money, at which point they'll issue equity and it'll shoot back down. And so we see both of these situations that we don't stay at the target all the time because of these transactions costs. It's just too costly to stay there. And so you end up basically going back and forth on either side of the target, but always seeking to be on average at that target. Now, I've told you about 3 theories. And the fact that I've told you about 3 theories probably lets you know that we don't have a good theory of capital structure yet. In fact, we don't have any capital structure theory that perfectly describes all of what we observe as far as capital structure in the markets. And so what we've done is gone out and identified 6 reliable factors, and I could list them off, but you can read them in the paper. 6 reliable factors that predict basically 30% of the variation in capital structure from firm to firm. So we know of only 6 things that reliably predict capital structure, and we can only predict 30% of the variation that we observe. Where is the rest of that variation coming from? Well, 60% is coming from what we call firm fixed effects, which is where we have firm-specific things that are driving their capital structure. In other words, we could not just take information from their balance sheet and enter it into an algorithm and come up with an accurate prediction of how much debt they would have in their capital structure, because 60% of the variation in capital structure is determined by idiosyncratic things at the firm. Perhaps like having a founder who is in charge of the firm. You will notice that those firms run on less debt and more equity, and that would have nothing to do with any of our models. Okay, so where does this leave us? Sadly, in finance, as I moved along in my studies, what I noticed is that the more we know that we don't know. And so after you have your entry-level finance class, you assume that we know everything about finance. And then you get into your master's level finance class, and we start to show you a little bit behind the curtain, and you realize that we really don't know as much as you might have thought. And now that you find yourself toward the end of your graduate studies, I'm going to share a terrible truth with you, and that is how very little we know and how very little we can predict about one of the majorly important things in finance, capital structure.